Good day and welcome to the Deal Economy, Predictions and Perspectives. This virtual event features 4 days of online sessions exploring the opportunities, obstacles, and risks that dealmakers face in the current environment. The Deal Economy features daily broadcasts of panel sessions and interviews, and your registration provides access to the entire week of sessions. You can view them live, as you are doing now, or on demand at a time that is more convenient for you. All sessions are being recorded and will be posted on the Deal Economy website within 24 hours of the live session. The Zoom link that you're using for this will remain the same all week, so you can use this to view any of the sessions for the remainder of the event. My name is Eric Salvarez. I'm the Senior Program Director here at the Deal. And before we get started with this session, I just want to make a few housekeeping notes. First, I'd like to thank all of our sponsors for making this event possible. Thank you to Aon, Citi, Kroll Mooring, Debevoise and Plimpton, Edelman, Lincoln International, McDermott, Will and Emery, Paul Hastings, Proskauer, SierraConstellation Partners, Sullivan and Cromwell, and Winston and Strawn. I'd also like to thank all of our panelists for taking the time to participate this week. We have some really great discussions, and we wouldn't be able to do this event without your insight. We'll be taking audience questions today. So in order to ask a question, just click the Q&A button at the bottom of your screen. You can type your question into the box, and that will come directly into our speakers. Please feel free to enter your question at any time throughout the discussion, as we will be going to questions during the panel. Also note that there's an upvote feature in the Q&A. So if you see a question that you like that was asked by someone else, simply click the thumbs up button, and that's going to move that question up to the top of the list. Okay, we're going to get started with our session. This is Riding the Second Wave, Opportunity Spotting. And I am going to turn this over to my colleague, Stephanie Gleason, who's a bankruptcy reporter here at the Deal. Stephanie?
Hi, everyone. Thank you for being here today for our panel, Riding the Second Wave, Opportunity Spotting. We're more than 6 months into a pandemic that has rocked our economy and sent scores of companies into bankruptcy, but much of the distress we've seen this far has been from companies that were already very vulnerable. The second wave will be different, presenting a new set of challenges and potentially opportunities. Here to share their valuable insights today are Larry Perkins, Justin Rollins, and Alexander Stevenson. Larry Perkins is the CEO and founder of SierraConstellation Partners and has nearly 20 years of management and consulting advisory experience with companies undergoing transition. He has enhanced business performance for numerous companies on projects ranging from interim management, profit improvement, and working capital management to strategic planning and transaction execution. Larry has served in a variety of senior positions to numerous middle market companies and is particularly skilled at assisting clients through challenging situations. Justin Rollins is a partner in Paul Hastings' financial and restructuring practice based in Los Angeles. He principally represents funds, lending institutions, companies, and committees in providing a broad spectrum of services, including counseling for corporate governance matters, fund formation, acquisition, divestitures, debt offerings, refinancings, and recapitalizations, with an emphasis on distressed and special situations. Alexander Stevenson is a managing director with Lincoln International. For 25 years, he has advised companies, creditors, and other stakeholders in challenging and distressed situations involving approximately $80 billion of total financial obligations. He has comprehensive experience in special situations driven by overall economic conditions, capital market trends, sector disruption, or situation-specific factors such as poor management, customer loss, and commodity prices. He has advised on distressed M&A, amendments, waivers, debt for equity conversions, plans of reorganization, and other financial restructuring transactions. Now I'm going to turn things over to Larry, who will lead our discussion today.
Thank you, Stephanie, and thanks to the Deal for having us here today. Just as we get started, and I'll get the rest of the team here talking quickly, but there's an expression that people are throwing around right now a lot, the expression, may you live in interesting times. And just thinking about it, I think these are certainly interesting times, but I decided to look into that expression itself and it's muddy, just like the times. So the expression itself used to be a Chinese curse, and they used to say it as a curse that, peaceful times are not interesting, so interesting times are not peaceful ones. And then it was kind of changed because apparently Joseph Chamberlain in the 1800s, who was a pretty famous British politician, co-opted it and made it the other way. So I think the theme of today is really trying to find the opportunity in what are obviously very interesting times. And I think Alex and Justin will be able to weigh in on that. And I think the theme in general is there's carnage out there, right? We've seen what's going on specifically, in the bankruptcy markets and other things like that in specific industries. But I think that's part of the story. I think the other part of the story is what we're here to talk about today. And it's really, where are the opportunities in all this? There's still an awful lot of people that are transacting on a day-to-day basis. And I thought Alex and Justin could give a great perspective on what that looks like. So without further ado, I'll kind of start opening it up for questions. And Alex, I'll throw the first one out to you. That I know you've been slammed here, and your firm has been slammed, and group has been very busy here. And I'd like to understand kind of what types of opportunities you're actually seeing right now, what types of deals, whether it's industries otherwise, but would love to get your perspective on that.
Sure. Thanks, Larry. It's been really interesting as the market has evolved over the course of the last 6 months. What we've really seen, I think, has fallen into two categories. The first being the usual suspects: the retailers, the restaurants, the gyms, the movie theaters, some elements of retail-focused healthcare that have been directly impacted from a liquidity standpoint by the pandemic. And the second group, which is where we've been spending most of our time, is those companies with what I'll call pre-existing conditions, meaning they were troubled or over-levered before the pandemic, and continue to be, and the pandemic just kicked them over the edge. And so they're put in a position where they either need liquidity that their sponsor or lender can't provide, or need some more fulsome restructuring transaction to occur. What I think is more interesting is what we haven't seen is those companies that are going to be impacted by the long haul of the pandemic. And by the long haul, I mean the long road to recovery in the general economy. So companies in the aerospace sector will potentially see auto industry, other event-driven companies that are going to face a really long haul to recover from this. And that's where I think the next wave of restructurings is going to come from, in addition to those companies that survived the initial wave by borrowing a tremendous amount of money against their assets. And when their earnings normalize, they don't normalize to a level where they can actually pay that money back. And so I think those are the two areas where you're going to see, both in Q4 and into 2021, an increase in activities in the restructuring sector.
Yeah, I mean, I'd add on to that. I guess it's not really necessarily the restructuring sector, but we've seen it. There's a ton of industries on the rise right now, right? There's home-based delivery, groceries, foods, those types of services, home-based diagnostics, anything that says tele in it, telemedicine, teledental, some of those types of companies. And some of those companies, they need cash, right? Like, virtual reality, online gaming. So one thing that we have actually seen as well on for those opportunities are, I have a couple right now that are pharmaceutical related, where it's a company that has a good idea, good product, needs money. And industries that, any company that needs money, whether it's in a good industry or bad, is a great target.
Yeah, I think so. I mean, it sounds like thematically, what I'm hearing you guys say is, there was this kind of first wave that was the ones that were probably, I like how you said that, Alex, pre-existing conditions. And then the second wave, it seems like, is really industry focused, right? It's the travel and tourism, hospitality now, all those sorts of things that we're seeing. And then the third wave is TBD, when and where that's going to be. And maybe we talk about that later. But I guess specifically, what are you seeing as the opportunities on either your side? I'll put it to Justin. Kind of, what are people doing? How are people transacting? Because you're not seeing all these companies just implode and fold up shop. People are doing deals there. I guess, what do you see as the pockets of opportunity within even the exposed industries right now? And I'd add, I'm working in casual dining right now. That's an example of something else. Gyms, I mean, all these sorts of things. I'd be curious to see how you and your clients are dealing with those situations.
Yeah, I'd say that some of the clients have more of an eclectic approach and some are a little bit more focused. But when we're looking at the deals, I mean, as far as how they're sourcing them, it's going through people like you know, Alex, looking for restructuring consultants where there are potential opportunities, looking at the public, you know, debt market, looking at capital markets, looking at where bond issues are, but then finding a company that they like and there's some core thesis. So we have some clients that are very focused on auto and they're willing to buy debt and hold the debt. And in some companies that they're not even sure if they're going to restructure, right? There's debt trading. It's funny, actually, auto debt was trading very low. Alex probably knows better than me. Early on, like March, April, and then it kind of ticked back up. Some of these opportunities went away, and now auto's back kind of where we thought it would be. But it kind of depends on what your thesis is, right? Like there's some people that have, you know, a thesis, you know, we have more of a protectionist world now. There's, you know, taxes, limitations on trade, other things like that. So there could be a company in the United States, and I'm speaking hypothetically, although we have some active ones that are in this type of sector, that manufactures some good that's really not manufactured in the United States. It's a pretty decent company, really needs cash. Maybe it has some real estate, you can unlock some opportunities. But what I'm seeing with our clients right now is a relatively deep dive into those types of things. So they're looking at the transaction, saying, is the debt trade good enough? Or, you know, if they're coming in fresh and, you know, they're not doing it through debt, you know, what are the opportunities? So really looking at the credit agreements, seeing if there's opportunities for spinoffs, opportunities for sale leasebacks, you know, what type of baskets are available for those types of opportunities. So it's, I'd say it is in some ways focused. Some of our clients are very focused on, and I think it does depend on your thing. Like right now, you'd say hospitality is terrible, right? Travel's terrible. But for some businesses that have reopened, if you went to Arizona in June, right? There was a ton of pent up demand for this stuff. The local, you know, Orange County, you know, in California, hotels have had very, very strong results, some of them. So it is funny, like there's, some of this is also just trying to think of like, well, is there a long-term shift this way? Is there going to be more domestic travel? Are you betting on domestic travel? I've seen a lot of papers, which I think are very interesting, just going through actual COVID deaths rates, right? And what that means, and then comparing them to what people's perceived threats are. And people's perceived threats sometimes are overstated, you know, and so they look at, well, maybe what we really need to work on is like industries that focus on you know, enhancing people's safety. You know, that we also have you know, defund police going on, things like that. Private security. You know, like there's other things that I think are that are interesting. But with each one of them, there's been definitely more of a focus and a deeper dive on the diligence side, at least for my clients, than I've typically seen.
Now,
Yeah, I would add that.
Sorry,
Larry. I would add that what we've seen, and I guess it's true across both the distressed and the healthy market, is that companies that have performed well are in one of the sectors, Justin, that you mentioned, that, you know, have a sort of new purpose, right? There's more focus on them because of what's happened. That those companies are now actually worth a lot more than they were before to investors, and so valuations in those sectors have gone up. Whereas that might be counterintuitive to a lot of people on the phone. There are sectors like that where valuations have actually gone up, and there is more than adequate, you know, debt capital to finance those types of situations in the debt capital markets as well. And so it's really a tale of two cities in the market, right? It's companies that have either a new use case because of the pandemic and have done really well, or have otherwise been insulated from it, food businesses, et cetera, things like that, that are still trading at high multiples, that are getting financed at pre-COVID levels. There's been no change, really. There was initially, but it's all normalized now. And then there's companies that have been more impacted, or people believe will be impacted over time, like commercial aerospace, to use an example, where those businesses could get ABL financing, but they can't get cash flow financing. The thing that I think people are trying to find, and where there's been a lot of money put aside for is what I would call liquidity solutions or structured capital solutions. And a lot of private equity funds created side pockets for this or raised funds around it. Credit opportunities funds, obviously, we're already in this business, but they're looking for those businesses that were impacted where they can provide a solution at a trough and ride it back up and get the equity upside from the recovery. And I think what we found is that there've just been fewer of those situations so far than we would have all expected because of PPP loans, because of really accommodating lender practices so far during the cycle, because of really aggressive cost cutting that companies did that they maybe didn't do as well in the past. A lot of different reasons for that runway being extended without having to without having to draw on that type of capital. But I think that's where the real opportunities are and where people are really trying to find those sort of diamonds in the rough that will come back out the other side of this, but have a near-term liquidity or valuation issue that requires third-party capital.
It is fun. Okay, go ahead, Larry.
Yeah, I chime in a little bit on the same theme as Alex. I mean, I think you're talking about kind of this haves and have-nots type of situation where you've got the haves, the ones that are called pandemic proof or pick your crisis proof right now, that they're thriving in that environment. And then there's kind of the everybody else. And we've got 40 or so clients ongoing right now, and it's kind of a mishmash of both. I think there's a combination of have-nots, kind of decidedly have-nots. Then there's a group that's kind of hanging on for their life in some ways, and then there's the ones that you can turn into the haves, in a brutal extension of that metaphor. But I think that the idea is that there's if you can make yourself pandemic proof, if you can make yourself viable in this market, you're worth a ton. And I think what we're doing with our clients right now is just bargaining for time, right? Kind of bargaining for time. I'm going to say, in some ways, hoping that something good happens, ranging from the V-shaped recovery that appears to be very elusive to more likely additional government money coming in one form or the other, or a bright idea that comes up or an opportunity that you can pivot to in light of a customer going out of business or somebody else out there. So right now, I mean, what we're focused on is just extending runway as much as possible and hoping, planning, thinking about how to kind of get that turn. And I would guess it's the same thing with you guys, but Justin, I know you were about to say something.
Yeah, no, I going off of your haves and have-nots, it's interesting like this is with personal investments. Like, what am I going to do at the end of the third quarter, or what we're expecting at the end of the third quarter? There was a lot. So there's a ton of money sitting on the sidelines. Yeah. There's record years of private credit fundraising in 2019. A lot of the people also have already shifted to special situations, venture debt. So there is a lot of money, and that's probably different than the last economic downturn we saw, where there might have not have been this level of volume of private credit. Mm-hmm. But the other thing that did happen was there was a really robust response to the pandemic. So when things shut down, my first 2 weeks of calls were really, hey, do we honor the delayed draw term loan that just requested came in? People hoarded as much cash as possible. And then there's the PPP loans. And you saw a lot of people that were aggressive with PPP loans. Some of them, like, some of the restaurant chains ended up returning their PPP loan money, so they didn't really have it. But a lot of restaurants, they pulled this, 10, sometimes some more than $10 million, depending on how their corporate structure was, to basically have that. So you had that. And then we also had, which I thought was kind of smart, we did a few of these. We did some pipes where, small cap public equity, the prices were just ridiculously low. And with a pipe, you could come in, you could get very significant percentage of public company equity that was worth, 300 million and was currently worth 20 million. And there are things like that, some exchange offers to, basically kick bonds down the road, a lot of forbearances. So you look at this and you're like, okay, well, we're 1 quarter in, now we're 2 quarters in, right? And now we're going to get to September 30th. I don't know if it's the same. Without divulging like client conferences, things like that, I think that some of our clients are probably going to be more proactive going forward. And now what that means is, are they going to be more proactive against the have-nots anyway? Like, are these businesses, is this going to be another oil field services, string of oil field services bankruptcies where someone doesn't want to buy anything or not? I don't know. But but it will create opportunity. There's going to be opportunities out there, and there's opportunity even in those. Like you look at some of them, there's been some interesting cases that have filed where they have major real estate positions, or they'll have like a division that does like industrial work that could go across applications. So there's probably other opportunities that come out of it, but yeah, the have and have nots. I think it seems like it's largely cash dependent. Who had cash at the time, and people were able to kick that can down the road pretty far. I'm amazed. Like there's some hospital chains that have lost billions of dollars over the last 6 months. No one really knows that because ICUs are occupied, but there's no elective surgery. There's a bunch of other things like that. What happens with that? And we've been kicking the can down the road. I think there will be quite a bit more as far as opportunity, this quarter, next quarter.
Interesting.
Right. I mean, at some point, everyone's borrowed so much money either on DDTLs or revolvers or from new capital sources where they had unencumbered assets to get through this. I mean, just look at the airlines who've leveraged themselves up billions and billions and billions of dollars, right, to get through this. At some point, those companies have to pay that money back, right? And if earnings don't normalize to a level that supports it, you're going to see, another wave of restructurings, filings, defaults, et cetera, next year, whenever the stimulus money, sort of runs out and we get more back to normal. And I think what we've been hearing is, initially, particularly on the commercial bank side, commercial lenders or the regulated lenders were sort of directed to sort of go easy, if you will, on their borrowers. And they weren't required to risk rate those loans based on post-COVID numbers. They could use pre-COVID numbers for a period of time. I think they're now reverting more back to normal. And so they're going to have to start taking more traditional lender actions in those situations, which will also drive to, I think, Justin's point, maybe more aggressive, exercise of remedies by lenders to force their way out of situations where they probably viewed April and May as not really having any effective tool to do that because there was nothing to do. Now there's more visibility. There's certainly capital chasing all these deals. They view themselves as a way to get out. And so you'll see more lender-driven, distressed M&A deals or restructuring transactions as we head into the back half of this year and into next year.
I guess for both of you guys, I mean, it's a theme I've seen. We field a lot of calls from direct lenders and other people. As Justin said, I think, record levels of capital raised in direct lending over the last handful of years. And I feel like there's a lot of activity, but I'm not quite sure how much is actually transacting on kind of new deals, right? I think there's a lot of people chasing, a lot of people looking, a lot of people trying to be opportunistic. I guess from your all perspective, and I'll put it to Justin first, what's the difference between the ones that are looking and the ones that are closing? Is it just a function of risk tolerance, or is it a function of experience, operational acumen? Kind of what's your view on that, Justin, in general? Because there's so many people looking for deals, and I just don't know who's actually doing stuff.
So risk tolerance probably has something to do with it. And I think that.
And does that rhyme with yield? Does that rhyme with yield? So
Yeah,
I mean, what I'm saying, the 15, 18% guys are doing deals all day, but the 6% guys aren't. Is that what that means? Or
I mean, it is interesting. There are some deals, like everything kind of got put on hold around March 15th. And then some deals creep back, there were with good sponsors, and the deal would basically be the same pre-COVID deal that you'd see with just better pricing, and that's it. And for a lot of my clients, we didn't win those deals. But those deals closed. There were lenders that found those deals. They were competitive. There were multiple, people on the tree. They were looking at the deal. And I think that there's some lenders that just had a greater appetite. Now, some of them that might prove to be true because we've seen that there are very pandemic resistant businesses, and some of these probably fall into that category as well. Mm-hmm. And so there's a lot of people chasing it, but I think that experience matters quite a bit too. People that have been through this a few times, they know what to look for. We had a deal that we had to get closed. There was a holdout lender, just taking a look at the documents, just the threat of a CERTA transaction was enough that they got the deal done. So there's experience what they look for. And I think the other ones, So we have a few clients that are very industry focused, and they're finding things. Whether some of it is taking a while, like some of it's buying public company debt, sitting on it. One of them, that just went through a bankruptcy. They ended up being the winning bidder through a stalking horse. But we did the debt purchase initially on this company. This was like one of those companies that's kind of distressed pre-COVID, and we looked at it, thought there's some opportunity here. If not, that maybe the debt will pay off at par, and there won't be anything. But they kind of embedded themselves into it. But they're looking at every single, like some funds that are looking at like every single auto deal, every single paper deal, like whatever those are, and they find that those industries attractive. So I'd say that experience seems to matter, appetite seems to matter, what the company is itself. Like going back to that list of, if you're doing online gaming or video games or security or have a new staffing approach or some of those things, those are good. But the other ones that are interesting is going back to hospitality. There's some funds that actually are kind of bullish on the hospitality rebounding at some point with a focus on domestic hospitality. So there are deals getting done in that space too. The one I think that we haven't really seen much of, but what was interesting is real estate. Commercial real estate. I think we'd all look at it and go, long term, it's looking really bad. You had Prop 15 in California, that looks really bad. There's a whole ton of reasons why commercial real estate doesn't look good for the long term future. Then again, one of the buildings in downtown, the Korean Air building, just refinanced at par. Anyone who bought that debt, people were smart. They looked at it. They looked at the financial wherewithal of the company behind it, made a lot of money. So there's some opportunities out there, I think, for people that are experienced debt traders, have a focus, really know whatever they're buying. So we are definitely seeing deals get done. I'd say that August was the busiest month that we've had since COVID. I don't know if that will continue into September. I figure on front end type deals. I think it's going to probably take a turn more towards the distress side, but we don't know. Who knows?
Yeah, same question for you, Alex. I mean, what are you seeing? I mean, that was a great answer on the lending side and the direct lenders or funds that you deal with. What are you seeing on the acquisition side, Alex? I mean, I know you and Lincoln do a ton of that work. I mean, both from the strategics as well as the sponsors. As a quick aside before I let you answer, I think it's fascinating, the term special situations, because depending on the market, special situations can mean a lot of different things. I feel like it's ebbed and flowed into being distressed versus truly something unique. I feel like everyone who had a special situations type operation is now a turnaround type investor. And I'd be curious to see what you're seeing and what sets the people apart who are closing versus looking.
Yeah, look, I mean, I think there's, our M&A business has rebounded to probably 80% or 90% of what it was in terms of deals in the market and activity level. And it's mostly around tech, food, pandemic, we're alliteration happy at Lincoln. So recession resistant, pandemic protected businesses. And those are getting done at high prices and closing, just like they normally would. There's obviously been a backlog and a sort of push to the right of deals that got put on pause in March and April and May, but those are largely coming back. I think what we're seeing a lot of looking around for is what I mentioned earlier, which is this ability to put junior capital into a situation and solve a liquidity problem, but get equity upside coming at the back end. I mean, that's the one thing that's really surprised me, that there haven't been as many of those, call it rescue deals, as I would have thought. If we had this panel on April 1st, I would have said we would have been overwhelmed with those types of situations. It just hasn't played out that way for all the reasons we've talked about. And so I think there's probably actually a lot of frustration at some of those funds that they haven't been able to put that money to work in those types of environments, right? Pick your fund that had a ton of liquidity going into this. They probably made a lot of money in the secondary market in March trading distressed loans, right, when they all gapped down to 70 cents and then went right back to 95. But they've had difficulty putting money into situations in meaningful dollars since then. I mean, there's certainly deals getting done, but it's not nearly at the volume that everyone thought would be. So there's billions and billions and billions of dollars sitting on the sidelines waiting for, opportunities.
Yeah,
And doing a lot of looking around.
Yeah, just as anecdotally, exactly on that point, we're involved in a situation right now, healthcare company, similar to what Justin was talking about, that's been, on the wrong side of the trade as far as COVID goes, but we were, planning on likely going into a, bankruptcy related process in the April, May timeframe. Wasn't a huge capital structure, but I think there was an ABL in the $60-65 million range that was drawn. And I think through last week so far, we've gotten $77 million of government financing at this point. So, it absolutely solved a problem balance sheet wise. It didn't solve anything operationally. That's what we're kind of working on. But I think, there were people salivating at the opportunity to do a dip loan or an expensive type takeout or a rescue deal. And I think everyone just said, what the heck's happening right now? Because, the bailouts keep coming. On internal calls, it was kind of pennies from heaven. It was the miracle of miracles in my business because we look like heroes just because we hung around. And I think that's a big part of the theme right now is that hanging around. Yeah.
That's happening on the direct lender side too. Well, the other thing that we thought might happen would be that there would be more distress inside the direct lending funds themselves.
Yeah.
And they would be forced to sell paper or sell portfolios,
yeah.
which is something they haven't historically done, except in rare instances where you had an undersized debt fund that just needed to be absorbed by somebody else. That just really hasn't happened. So there haven't been those opportunities to buy into the private debt market at a discount in really any volume. I'm sure there's examples where it's happened, but we haven't seen very much of that at all. Secondary market, just in some of the situations you referenced, where you've got tradable securities or liquid loans, certainly those opportunities exist, but it just hasn't materialized that way in the middle market where there's more concentration on private lenders.
And just as one theme, just while we're on the topic of industries, because we haven't covered it yet, just being out here, at least personally here in LA, and we do a lot of work up in the Bay Area, Silicon Valley. One theme that I picked up, and I don't think it's necessarily tech specifically, but companies that are reliant on fundraising to get going, like many of these tech companies are. I think we've worked on, 3 unicorns here in the last 6 months, just because they depend on, ongoing capital raises to make their business plan work. That's just part of the plan. And I think through COVID, that was cut off at the knees. I think any additional fundraising, either it was an opportunity or opportunistic to reset the deal at that point. And I think, we had a couple public ones. I won't go to their names specifically, but, a couple of them, were on track to continue the fundraising. Everything was largely on plan, business plan wise. And then everyone hunkered down for 6 months and that changed. So when I'm looking at opportunities, if you were convicted about a business before, you can probably get it for a third of the price of where you were, now. I'm making up that number, but these companies are really in a bad way because with the venture capital market at least being largely shut down right now, even the large ones, it's been interesting to see, except for the tele industries that Justin talked about. Yeah, Alex, I know when we were talking on the phone the other day, are you seeing, like, structure-wise, are you seeing any bells and whistles on these deals that are different than you were before? And Justin, you would say the same thing in loan documents, but what are some post-COVID changes you're seeing to deals kind of specifically?
Yeah, well, I think for debt transactions, for financing transactions, you're largely seeing in those, again, the pandemic protected deals or deals where there's acquisition or there's financing coming in behind them from a sponsor or other acquirer, i.e. fresh equity.
Yeah.
Those deals are trending right back to where they were before. I think some of the baskets and available amount concepts and incremental loans have kind of gotten downsized a little bit, and I think people are a little more leery of taking Perry revolver exposure in a significant degree because of all the drawdowns that happened. So you'll probably see more anti-hoarding provisions and things like that in those documents. But for those deals where there's equity coming in, they're largely the same. There's not a material difference, maybe 50 basis points wide on pricing, maybe a quarter turn on leverage, something like that, but it's not material. In some cases, it's even more aggressive than it was pre-COVID for those businesses that would really perform well. I think where you see a differentiation that's more than it was before is for what I would call like a storied refi, where there's no fresh equity coming in. Those deals have priced out, or the spreads have widened out more, in part because a lot of the, call it more down the middle lenders or traditional lenders are only participating in new money deals right now, or only focused on that. And people have narrowed their industry focuses to software and other protected areas. So if you've got something with exposure to something they don't like, there's just less depth to that market. So it's widened out more. So that's the real difference in the market right now.
Now, how about you, Just? Are you tearing up the forms pre-COVID? Or are you looking at the same forms, just tweaking them? What's the analysis?
I'd say there's a little bit, there's probably more emphasis at the beginning about, or more discussions internally about what can go wrong. So kind of like exit planning. There's a lot of that. I don't know if that really ends up working its way into the documents that much more, but there are a lot of discussions about, well, what if this happens, and how do we think about this, or what does this guarantee really mean, or like things like that you may not have gotten a question on before. I think there's also a little bit more focus on baskets. Baskets have obviously been abused, with the J. Crew and Chewy's transactions. So if you have a dividend basket and an unrestricted sub basket or a restricted sub basket, you can move to an unrestricted sub and you can aggregate them all together. People actually try to do the math and go, oh, I can aggregate this to $250 million, $300 million, and that matters. There's also more of that on what those baskets actually mean. Is it cash? Is it IP? So there's some limitations on that. But that was probably happening anyway, like as far as, I don't know if that's really a COVID distinction, but that was happening. So there's that. There's also a little bit more emphasis on the sacred rights. You had your Sierra transaction that can be fixed by a couple of tweaks to the sacred rights in some part. I think that people are thinking about that, who their partners are in that. And then going to Alex's point, there is definitely like a cash hoarding emphasis on this. And then the other one that we've seen creep in, but it's taken a while, and I still don't, if it's the majority in large cap deals, it's probably not by a large margin, but it's these COVID max and EBITDA add backs for like these types of events. And that's, I don't know, Alex, what you're seeing. I'd say that maybe we track this stuff. We think it's about 50-50. So it's really not as much as you'd expect for that.
50-50 as far as being able to get the max.
Backs.
Yeah.
Yeah. I mean, I think in amendment transactions, we've really just seen covenant holidays that try to get around that, right? Where the covenants don't get measured again until next spring. So you don't have to deal with the real shutdown months. Or they start building again. So say you start, building your covenant EBITDA in September. And so you sort of eliminated the summer from the calculation where it was materially distorted. I think there's a lot of focus on that though in new acquisition deals where there is some sort of COVID, and it goes both ways. I mean, we see COVID bump and COVID, decline, and people are trying to get their arms around that. Is this overstated because of COVID or understated because of COVID? And there's certainly a cottage industry developing around how to calculate those numbers. We have a lot of, from all our different deals, have a lot of different guidance we give people on how to do that and track the numbers and everything else. How it ultimately gets weaved into credit agreements, I think, is developing over time.
Yeah, I'd say one of the other things, and these are actually somewhat more fun, is we have done more deals where someone will call and like, hey, are you an expert in doing a last out term in a revolver, and things like that, and what do you think of? And we have our thoughts on that, but that's not something that was necessarily common. So there does seem to be on some deals a little bit more brain damage around like how are we going to get in money, and where is it going to come in, and where's there space to put the money in? And that for me, those are the more fun deals. But we're definitely seeing an uptick in that. But I'd say, like Alex has said, not as much as you think. On companies like that where they're stressed, like the desire to go and put more money in hasn't really been as robust. And for other companies, they have a ton of cash. One question I did have for both of you, because I haven't seen any, but speaking of like PPP and pipes and access to cash, has anyone transacted a Main Street loan?
Yeah, I mean, I'll take that one. It's not for lack of trying. My take on the Main Street right now is, I mean, it sounds like a good idea, but the issue is, unlike the PPP, it requires consent of your senior secured lender, because it's basically, as I understand it, pari passu with a senior secured lender. So you've got
Right.
a senior secured lender who is likely concerned about their overall collateral value, and then you're going to layer on an additional, participant in their bucket at the same place. And I think they're kind of like, hey, thanks guys, but no thanks. And then you also add on the personal guarantees in many of these cases, because it's ultimately an SBA program. Fortunately or unfortunately, I think the PPP was a lot of medication in the system, but it seems like Main Street appears to be a little bit of a dud so far. That's my perspective.
Yeah, we haven't really seen anybody be able to avail themselves of any relief under that.
Yeah.
Yeah, I thought that that there's one of the options is a refinancing option.
Yeah.
And I thought that there might be some private funds that are in private credit that really don't have any cash available, that are believers still in the business, that might go and let themselves get refinanced out. They'll convert their debt to equity, or they'll go pari, and they'll try to get some more money in, but those businesses must not be attractive enough. And then it seems like there's been a lot of obstacle, because a number of lenders, they still have to maintain 5% risk, even though it looks like the federal government will securitize those loans. Yeah. There's a risk. And the other ones are just the basic limitations on the program itself. And the fact that you're signing, you're attesting to certain things that deal with federal statutes that could get in a lot of trouble if it turns out to be wrong, even if you meant it to be right in the first place. So I don't know. Yeah, I think we might have one that's actually maybe going to go right now.
Across all of Paul Hastings, we have one. That's good. No, I mean, I think it's the difference between the two, because I think PPP was so fast and easy. I mean, we did that for virtually all our clients. At least took a look at it, assuming we were qualified, and it was so fast and easy. I think that's why I think it helped so much, because it just kind of came in. Now, talk to me in 2 years when we uncover all the fraud that was done in that program, but that's clients in 2-3 years from now. But I mean, it's remarkable how fast it moved, but I think that's what made it work. And, when we've done the investigation on the Main Street program, it's like a typical underwriting process, right? I think while the PPP had virtually no risk for the bank, the Main Street program has risk for the bank. So I think they're looking at it a little bit more professionally. So it's just, I'm not saying it's a bad program, but it's just not the panacea in some ways that I think people were hoping it would be.
Yeah, I think more of the federal stimulus money has gone into the bond market by far than into Main Street lending.
Yeah.
Buying securities in the bond market and propping up the bond market.
I think that's probably right. I think a theme I'm seeing, we haven't even talked about this one before yet, guys, but I think there's always this theme when you go through these points of disruption where there's kind of back to the future, what's old is new. And I'm seeing that kind of manifest itself in two main ways. I'm seeing the return of the family office, or for lack of a better term, the really rich guy who's starting to invest again. And I know Justin and Alex, we both talked about specific deals in situations like this before, but I'm curious to see, like, what's new this time? Is it new ideas? Is it new participants in the market? Or is it truly kind of back to the future? Like, we're seeing things from before. I'd love to get your perspective on, are we innovating this time around in the distressed market? Or is this, back to what we did in 2008 or 1991, depending on how old you are? Alex, that's a hard question, so I'll put you on the spot.
I was going to let Justin answer it first.
I'll ask Stephanie. Stephanie, what's your take?
Yeah.
Well, Justin, I mean, I know you do a bunch of work with family offices, so I'd be curious to get your take. Yeah.
I mean, there's definitely some innovation in the credit documentation, but I don't think that there's a huge difference other than some people are going to be very good at this because they're going to accurately predict like that there is going to be demand in certain sectors where there's none, and it looks like it's obliterated. So there's that, but I don't know if that's any different than the tools that people had years ago. One of the things that is harder though is there's a lot of money out there. So finding your opportunities and sourcing opportunities, I think is going to be as difficult as it could be. I had one client, he goes, I got to catch up, on like how much they were lending this year. And that's obviously not how they're going to approach it, but that thought is probably there with a lot of people. They want to find something. So finding the right opportunity and leaning into some sectors that really don't necessarily look attractive right now, we have a good thesis for, or the business is going to outperform, or you can they need cash and to make operational improvements. People are going to have success, but that's the same old stuff we've been doing for decades.
Yeah, I guess the thing I think that surprised me is the level of it's not really innovation, but just patience that everybody's had throughout this entire through the pandemic in terms of dealing with these issues. First operationally in a pretty creative way in terms of cost cutting and availing themselves of revolvers, PPP loans, and all the things that were made available for them to weather the storm. And I think now around supporting their companies and moving forward into the next year and creating sort of option value. I think Larry, you said, a lot of what you're doing is just trying to get to the next phase of this. I think people are being pretty creative about how to do that. And I think given the market is now, particularly the middle market, is so private debt and sponsor driven, right? There's a lot more flexibility when you've got two pockets like that can put money in, as opposed to having public companies and banks who are either restricted from a regulatory standpoint or who can't raise money easily. There's a lot more flexibility in those structures than there would have been in past cycles. And I think that's also contributing to the level of patience and the time that it's going to take for this all to unfold.
Yeah, I'll jump in a little bit too. I mean, I think, another theme, I totally agree with what you just said, Alex, but another theme that I would say I've seen is, things that people talked about for the last handful of years. I mean, let's call it what it was. The last, 5-8 years have been particularly frothy. I mean, there's so much money. If you couldn't get a deal done in the last 5-8 years, it was pretty damn hard to get a deal done, realistically. But then you had people that were kind of tried and true, debt buyers, loan to own folks, et cetera, those kind of people. They weren't really doing much, or they were having to stretch to do other things. And I think those people, kind of the debt rip deal, buy at a discount, try and make it up on a trade, on some sort of amendment. I think they're back in the market. The other thing, Alex, I thought you said was really smart. I mean, is fundamentally we're kind of interim leaders when we go into these client situations, right? And sometimes it's really hard for us to convince the client, borrower, whatever you want to say, to change, right? To make the hard decision to cut the business line that wasn't working. And it made our job easier because people are scared their pants off at this point. So I think everyone's doing the hard thing and leaned out. So in some ways, my thesis has changed. I thought there was going to be a lot more carnage down the road, but I think there's a lot more opportunity because I think these companies are probably going to come out stronger. The ones that are going to make it, I think, are going to come out stronger because they've leaned out, they've taken out that 15-20% of costs that they should have done 3 years ago that you just forget about doing. And I think that's what we're trying to lean into right now, is trying to get that story. Now, convincing, and this is what you guys do, particularly you, Alex, convincing the borrower or the owner that that's sticky, that's a whole different part of the conversation, but that seems like a big part of what we're talking about now. I'm just going to do a quick check-in on the Q&A.
We have a couple questions from the audience, just about if you're seeing any international players who are seeking to add U.S. presence as part of global positioning and macro stability rationale in COVID recovery environment. And also, if you would talk a little bit about if you're seeing activity from distressed ABL buying from traditional banks and lower risk lenders in this.
Go
ahead, Justin.
On the international side, we definitely are. I don't have a number of public deals that I could talk about, but there are a few. We were involved in the Technicolor restructuring. That's largely that's European money for a lot of it. It's basically a U.S. domestic company. There's definitely a bet on Technicolor. We'll see if that works out. We've also had some Japanese investors that have been pretty active looking for yield. It's interesting because one of the things that I've been busier on this year, and I know that Larry has too, is just getting CFIUS approval. Some other things like that. So we're probably that's probably I probably know my CFIUS guys better than I ever did.
Yeah, I mean, I think this. I mean, I'll chime in a little bit. I mean, this trade war or whatever war we're getting into with China, hopefully it's just a trade war. Is problematic, right? Because at least on this coast, there was a huge flow of funds coming in from China here over the last really 20 years, but particularly over the last 10. And I think that's changed a lot of stuff that we're working with right now. I mean, either existing people in the capital structure, I think, as Justin alluded to, the CFIUS issues that are out there, and just the general drumbeat around China right now has changed a lot. And I'm by no means expert, but even from my middle market interim CEO, CRO chair, you can feel it, and it's different than before. Alex, I know you have a huge international presence. I mean, what do you
Yeah,
guys?
I think we've seen. I don't think there's been much of a change in sort of cross border between the U.S. and Europe. I think that's sort of remained the same. To Justin's point, I think the Japanese have been active. What we've seen less of is, Chinese buyers, sort of getting active in U.S. processes, given the political turmoil isn't the right word, but the political concerns around the current situation, right, and the trade situation. So we've seen less of that activity, but certainly there's been some international interest in distressed assets. In the middle market, you tend to see, I think, less of that than you would in the larger cap market, where there's just bigger names. But nevertheless, I think it's largely unchanged, but for the China situation.
Yeah, I know this panel isn't focused on real estate. I think on some of the larger real estate, or even middle market real estate deal, 500 million, billion and a half. I think there's still a fair amount of international interest, from what I can tell. But again, with the caveat being international interest, except for the second largest economy in the world.
And on the ABL question, I haven't seen any sort of traditional ABL lenders sell their ABL loans. There were some rumors of portfolios of cash flow revolvers for sale earlier in the pandemic. Private lenders who had all their revolver capacity drawn by borrowers in a way they never envisioned, and they were trying to sell off some of that exposure. I don't know if those transactions happened. They weren't publicly disclosed to my knowledge, but I haven't seen anybody, any ABL lender selling off an ABL loan. I haven't seen that.
Sorry, I have to release signatures on a deal, but we've been pretty active on a couple of ABL deals, trying to get the ABL lenders to sell debt. It's been hard to get, unless it's a complete disaster. Like, I have a couple of examples where the lenders have basically been trying to get out of a credit for a while. That it's been a little bit more difficult than we would have expected, including in a couple of deals where I think that they should sell at a discount, but we just haven't had a lot of luck.
Yeah, I see the same. I think there's a lot of conversation about it right now, but not a lot of transaction. Takes two to tango in a deal like that. And I think there's a lot of people that probably want to buy the ABLs at this point. But I think my take is the lenders, especially kind of the bank lenders, we saw the numbers out of the large banks. They took huge reserves over the last couple of months. So I think that they have a lot of leeway to navigate what they can do with their workouts, from what I can tell.
Right. That probably makes them be more aggressive, right? Because they've already taken their loss. So now they'll look to move that paper off their books, and maybe they get a little gain on it and look like be heroic institutionally. So
yeah, it could be. I'm just kind of going, Stephanie, I'm just kind of going through the questions, trying to talk and multitask, which I know is not.
Yes, I know. If anyone else in the audience has questions, we have like 5 more minutes.
But I guess since we have a relatively short clock, I see a question coming in on.
Are any new issuances in the debt market still, since the pandemic, still covenant light?
Oh, for sure.
Yeah,
Alex, it's just shocking, but yes.
Yes.
And covenant wide, and I would say covenant wide. Cushions are still 30-35% on new money deals. The key there is the new money deals.
Yes.
The sponsors drive that market, and they're still able to get the cushions that they want, 30-35% on EBITDA, on leverage.
I'll ask the question kind of in the same way, on the non-new money deals. I know there's a fair amount of consternation when the PPP came out that, private equity owned companies weren't eligible for PPP because, they were supposed to kind of self-help themselves. I've heard of the mythical support from the sponsor, but I have not seen it yet, at least across my portfolio of clients. Have you guys seen self-help from sponsors who are kind of coming in to save the day on troubled borrowers or portfolio companies?
Yeah, we've closed a number of amendments with sponsors backing. Yeah.
Equity or debt?
Equity, there's a couple, so some of the sponsors are being a little bit more proactive. I think that they're better off with debt, really, like if they can get it approved. If in our deals, usually if we're going to allow debt, it needs to be with very, very, a lot of guardrails around it. But if you're going into a bankruptcy scenario and you think you're much better off having the debt. It helps you versus having like a new money fight during a bankruptcy. So we've seen a little bit of that. We've also seen sponsors buying debt actively of their own portfolio companies, and that's been relatively active.
We've seen that activity, but I think, Larry, to your point, it has been less than maybe we would have thought. I mean, I think we have a stat from our valuations database around amendment activity and what percentage of them actually were accompanied by a sponsor cash infusion, and I think it's like 10 or 15% of them had.
There you go.
Sponsor infusion of some kind. That doesn't mean they won't put in money later, but
Yeah.
for the immediate term, it was a lot of covenant holidays. They drew down covenant holidays. They had liquidity. They weathered the storm without a infusion.
I'd say
We've got one more here. Are the returns for structured finance or rescue financing generally lower than traditional distressed debt investing? What is the downside protection in structured deals?
Well, I mean, it's a bespoke security, so you're pricing equity risk probably in either case. So you're looking at high teens plus returns or targeted returns, or MOIC, multiple invested capital of 1.5 and up, depending on what your level of asset coverage is. And I think to whoever asked the question, with the extent there's downside protection, obviously you get more of a debt-like return. To the extent it's all equity risk, it'd be priced like equity. So it's a tough question to answer in a vacuum. It's really situation specific. Excuse me.
Yeah, I think that we look to put a lot of guardrails in those type of deals. It's a lot of it ends up being the thesis of whether or not you can take control.
Yeah, and what the negative controls are. I think that's what you're referring to, Justin, right?
Yes.
And I guess kind of since we're running up against our clock here, want to make sure we end on time. I would go around to you, Justin, you, Alex, and say, I guess if there's in one sentence or less, what is the biggest opportunity or theme out there that you're seeing to the investors here in the audience, or what would you tell your client here right now?
You would laugh at me, but I personally like, setting aside the industries that we know are going to be pretty good, like I've invested in some things like audio and stuff like that. But I think hospitality is underrated out of all those sectors.
Yeah.
Look, I think there's a recovery thesis that's out there. And I think for those people who have liquidity and have a little more patience and could wait out like a 2-year recovery scenario, there's a lot of opportunities there that a lot of people aren't going to be able to wait out. So if you're in that position, keep looking. And I think they're going to start to come, because the ability of existing lenders and sponsors to continue to support these companies when there aren't any more assets to borrow against and they run out of federal stimulus, is limited, right? I mean, there's going to be fallout from that. That's going to be the second wave that is in the title of this panel. And I think that's just coming. So I think just a little more patience and wait for it.
Yeah, I'd say the same thing. I mean, thematically, I would say there's going to be winners in just every industry we talked about, whether it's hospitality, oil and gas, everything else we've talked about that's beat up right now. It's identifying those opportunities where they have great leadership, great teams, great cultures, all those sorts of things. I mean, those companies are going to make so much money, and the people that invest in them right now are going to make so much money. And it's really about separating who are the ones that are really good and who are the ones that are just kind of in the industry. It's kind of like the old Jack Welch thing in some ways. I mean, that top 10% is just going to destroy things for a while. So really good answers, guys. Stephanie, I'll hand it back to you just to wrap up and close out.
Yeah. Thank you guys all for joining us today. I think you really provided some great insights and thoughts about opportunities where all this is going soon. So I really appreciate you taking the time, and to all of our audience for joining us today. I think that was a really helpful discussion. So thank you.
Thank you.
Thank you, guys.
Thank you. Have a good day.
Bye.